Welcome, and thank you for tuning in. You're listening to the Beyond 50 radio program. I'm Daniel Davis. On the program today, I think it's important that we think about ways that we can refund our retirement. One of those particular vehicles that you might consider out there is learning how you can fund your retirement through what is known as a life insurance settlement. It's certainly an alternative to accepting the insurance company's surrender value for the policy. We're going to discover what a life insurance settlement is, who qualifies, what types of policies can be converted, and the tax implications and much, much more. I'd like to welcome to the Beyond 50 radio program today our guest, Alan Silverman. Alan, thank you for joining us here on the program.
It's my pleasure, Daniel. Thank you.
Now, how did you get involved with life insurance and life insurance settlements? What's this all about?
Well, I've been in the life insurance business in what you might phrase as the brick-and-mortar business for over 46 years. It'll be 47 years this coming February. And it's just a natural outgrowth of the business. In other words, clients of mine who have policies that I sold them that are unneeded, unwanted, or unaffordable now, they want to change directions with the policies. And so there's an industry out there that's called the life settlement industry, and these are people who make investments in policies. And so it was just a natural progression that I got involved in helping my clients get more money for their policies than they could get if they cash surrendered them with their current life, with the life insurance company that they were involved with. So it's called a secondary market. So there's a secondary market that will buy these policies, and when they buy the policies, the new owner the buyer becomes the owner and the beneficiary of the policy, and pays the insured or the owner, the original owner, an amount once they settle on the amount, and everybody's happy.
Okay. Now, I know that a lot of times people will take out life insurance, obviously, for asset protection in case there's an untimely passing of, someone. And then, what we're suggesting here is actually pulling money out of it before something like that happens and using it now instead of potentially later. Is that what's going on?
Exactly. That what you described as a policy that's unneeded for one reason or another. It might have been a policy. There might have been a business situation where you had two partners and they had insurance on each other in case one of them died, and now they've terminated the business. They don't need that policy for what we call buy and sell arrangements, or for a business situation, key man situation, or things like that. And so the policy's unneeded, and they want to get rid of it or make a change. And so depending on if all the stars line up, they can sell that policy on the secondary market and usually get more money than what it's worth if it has equity in it.
Mm-hmm. Now, what specific kind of insurance is this used with? I'm sure, there's so many varieties, I'm guessing, of life insurance. What specifically are the kinds of insurance policies we're talking about here?
Well, there's universal life policies, which is a permanent type policy. Term insurance is a candidate as long as that policy can be converted into a permanent policy. There's universal life policies, which again is a form of permanent insurance. There's second to die policies, which are used for estate planning purposes, where you'll have one policy that's on the life of, let's say, a husband and wife, and they took it out for estate tax purposes, but for one reason or another, their estate is too small now because of government regulations that they've increased the size of the estate tax credits, so the policy's unneeded, or their estate has gone down, and there won't be an estate tax upon their death, so that policy's unneeded. And there's whole life insurance policies that people don't want. There's a myriad of reasons why the people don't want the policies anymore. And like I said, instead of sending it back to the insurance company, because that's really the first buyer of the policy, if it has equity in it, that's the first place they can turn. But after that, they can go to the secondary market if they're aware of it. And there's a lot of buyers out there that, again, if all the stars align and everything comes in right, the policy is worth a heck of a lot more than the cash surrender value.
Now, that's really interesting to think about that. So where is the real value in a third party coming in and buying these for much more than, let's say, the cash value settlement is in the policy? There must be some kind of an incentive for somebody to get involved with something like this.
Yes, and now you're getting into, what qualifies for again, what I call for all the stars to align. One of the qualifications is that there's been a change of health. The policy might have been taken out when the person was, let's say, 50 years old, and that person might have got received a preferred underwriting classification, and now because of changes in health, they wouldn't be considered preferred. So their life expectancy has really gone lower. That is lower than what it would have been had they stayed healthy. So it's called an arbitrage situation, where a buyer is going to look at someone's health records for the last 5 years. They're also going to look at the policy to see get a snapshot of the policy and to find out from the insurance company what the minimum premiums are necessary to carry that policy to, let's say, age 100. And so the third party is going to try to figure out what the life expectancy is of the insured, and what it's going to cost to carry the policy for the next X number of years, depending on when that person is 100 or so. And so that's why it makes it, if there's been a big change in health, then that means the life expectancy has gone down, and so that means that the new buyer might collect on that policy a lot sooner than they think, than would normally happen.
Now, how do they determine what the settlement value is of a policy?
Well, it's based on the life expectancy. Okay. In other words,
I know for a minute here, Alan, it almost sounds like we're kind of repeating ourselves, but I know it's going to go a different way.
Yeah, but it's the steps are we need to get copies of the insured's medical records, at least for the last 5 years. We need to get a snapshot of the policy, a new illustration, if you will, from the insurance company, and they make a determination based on those two factors, plus what's the premium to the face amount ratio. And without getting too crazy, let's say there's a $100,000 policy, but for one reason or another, the premium is over $5,000 or $6,000 a year for that policy. That tends to make it less attractive than a policy that only costs $2,000 a year. So there's a number of factors that go into it, and then the other factor that's kind of the unknown is what's the appetite, if you will, at a certain time of a particular buyer. There's a lot of buyers out there chasing. There's a lot of money chasing these policies, so to speak, and so consequently, it just depends on what their appetite is at when it's presented to them. And what I try to do is I try to get my clients, I try to get their policies into a bidding war where you have 2 or 3, minimum 2, maximum 3, 4, 5 potential and interested buyers that will keep bidding it up because they like what they see and they see a decent return on their investment. Because not only do they have to pick up the premiums and become the new owner of the policy, they have to pay the buyer something, so they have to figure out what's their return on their investment going to be after paying everybody for this policy, and are they guessing right in relationship to the person's life expectancy?
Mm-hmm. It just seems kind of complicated there, but I suppose that's what professionals like yourself do when you step in and you try to get people to understand why and when they should be doing something like this.
You're right, but it's really not. It's really not that complicated. All we're trying to do is figure out what their life expectancy is, and they send the medical records to at least two different organizations that look at the medical records, and they determine from the medical records what they think the life expectancy is, and they usually put that into they usually put it in months. In other words, this person's got 100 months to live, or 120. 120 months is 10 years. Okay. So consequently, when you're looking beyond 10 years, then the air gets a little thinner as far as the buyers are concerned, and they really sharpen their pencil because they don't want their money. They don't want to be paying premiums for the next 10 years. If they miss by 2 or 3 or 4 years, that means that their return on their investment is lower because they've had to put out premiums for a longer period of time. In other words, if it came back and it said that they would have a 10-year life expectancy, and they based all their figures on that, and then the person lived 15 years, well, that means that the buyer had to pay an additional 5 years of premium. So consequently, the buyer's investment, return on investment, has actually gone lower because he's had to put out more money. I know that might sound a little complicated, but it really isn't. It's pretty simple.
Well, that's what experts like you step in and do, right?
Exactly.
Now,
exactly.
It's pretty interesting too when you think about somebody who decides, well, I want to use this for my retirement, for instance, and we all know that once money comes flowing into the house, there's always the IRS wanting their cut. So how does that all work out here? How do you get someone to really plan this out?
Usually there's not a gain for tax purposes in the policy. The only way there'd be a gain is if the person put in X amount of premium and they got back more than X in premium that they had paid. For instance, if they had paid $1,000 a year for 10 years, let's say, so they put in $10,000. If they received $15,000 for the policy, they would have to pay tax on that gain, which is the gain was $5,000. So they would have to pay tax on a long-term capital gains tax on that $5,000, not on the whole 10 or the whole 15. I mean, so that it's not that bad, okay? And it turns out that they can fund their retirement. Some people use it for long-term care purposes. Some people use it for whatever, they all of a sudden have an infusion of cash, and they use the money as they want to use the money.
Mm-hmm. It's also interesting. And so now, when somebody cashes this out with you, do they get like a lump sum, or do you actually help plan to do this in allotments? How does that all work?
Usually the buyer wants to do a lump sum payment. And so then it's up to the seller, the insured, or maybe there's a different owner on the policy. They decide how they want to allocate the money once they get it. But the buyers do not pay in installments. They just pay a lump sum and either wire the money or send a check. It's actually pretty simple. After you do all the paperwork. I mean, there's a fair amount of paperwork, and there's a fair amount of disclosures, if you will, because one of the things that we try to stay away from, and that we always try to stay away from, is elder abuse. We don't want to be preying on older people with policies and entice them to do something that is not right. So that's why this is fairly well regulated. That's why there's so many disclosures. It's probably, the closing documents are usually about 60 pages long and require maybe 15 notary signatures and notification to the beneficiaries, to their family and things like that. So everybody's on board with what's going on, so that nobody comes back a year later and say that we tricked, if you will, an elderly person into selling their policy and cutting out, their current beneficiaries. We never get involved in things like that, and we've never had a problem. So we try to keep it as above board as possible.
Now, what type of people with policies wouldn't qualify or be good candidates for this life insurance settlement?
Right off the bat, the first thing that comes to my mind is younger people. In other words, I get calls all the time from somebody that's 50 years old and says, I've had this policy for 10 or 15 years. I don't need it anymore. I don't want it, or I can't afford it. And I basically tell them that if it is an equity-based policy, that they should go back to the original insurance company if they need the money, and that's their first buyer for whatever the equity is in the policy. Because the problem is that if they're healthy, they have too long of a life expectancy. They might have a 20, 25, 30-year life expectancy. Well, no buyer wants to be involved. In other words, pay for a policy for 20 years and wait for their return on their investment. So that's somebody. Usually we're looking for people that are 70 and above and have had maybe some type of change in health where from, like I said, it's an arbitrage situation. From when they originally took out the policy until today, there's been a change in health. Maybe they've had a heart condition, stroke, cancer, things like that, Alzheimer's, whatever. They need the money for either long-term care or retirement purposes or whatever, and their beneficiaries are set, so to speak. So the beneficiaries don't need the money anyway. So why should these people keep paying premium? And if there's no real need for the policy anymore. Mm-hmm. So, in answer to your question, the most unlikely candidate are younger people because they have longer life expectancies. Mm-hmm. And so I try to I can't do anything with those policies. There's no market there. How's that?
Mm-hmm. It's interesting because I'm looking at some of my notes here about what people can take. Some of these numbers are fairly astounding, actually, when you look at, for instance, here we have a male age 83, $2 million in face value universal life policy with a $120,000 cash value, an annual premium of $80,000, but yet this policy was sold for more than twice the cash surrender value. That's pretty amazing.
Yeah, but in that particular instance, based on the $80,000 of premium and the current low interest rates, the coverage was projected to lapse in 3 to 4 years at the current premium, and this particular individual had a short life expectancy because of health conditions. So what was happening was that they couldn't afford the premium, number one, and or the increase in premium. So they took their chances. I guess you might say they cut their losses. If that individual happens to live longer than 3, 4, 5 years, they wouldn't have been able to pay the premium anyway. So the policy would have lapsed. They would have lost their cash value of $120,000. So we were able to sell the policy for $300,000, and based on their life expectancy, we're still able to make a profit, and everybody's happy. So they got $300,000, and they cut their losses, so to speak, or potential losses. Mm-hmm. So now it's up to my buyer. Again, if my buyer made a mistake, then he made a mistake. Meaning, if that person will live 10 years, my buyer made a mistake. But they're big boys; they can cover their losses just fine. They're okay.
Go. Now, what is the process for people to obtain a life insurance settlement offer?
All they have to do is we have an application that they fill out, and we get all the information that we can about the policy. We also get their permission to contact the insurance company so that we can get what's called a current illustration or a current snapshot of the policy, which is nothing more than asking the insurance company what's the minimum premium necessary to carry the policy till age 100 with $1 worth of equity in it. And then we get the the insured to fill out a form, and that form, just tells us basic information about the insured, plus we get the contact information about the insured's current doctors, and we ask the insured to sign a HIPAA form, and that HIPAA form allows us to go to the doctors and acquire his medical records. Once we've got the medical records and the snapshot of the policy, we then send that out to prospective buyers, and we ask them if they have any interest in this particular policy. And we usually send it out to 6, 7, 8 potential buyers, no more than that. And these are people that we work with on a daily basis, so we know what their we call it a buy box. We know what they're looking for, and we try to send it to the correct potential buyers. They then make a determination, and hopefully after we've sent it to 6 to 8 prospective buyers, 2 or 3 of them will come back and show interest, and then it's game on, because depending on their level of interest, they start, how do I say it? They start bidding against each other, and we say, I got an offer of X, and the next guy will say, well, I'll give you X plus 10 or whatever the number is, and so we can bid up the policy, and because we work for the insured/owner, not the buyers. We're the owner's representatives, in other words.
Gotcha.
So we want them to get the highest amount possible. So the ideal situation is to get into a bidding war, and that's what we try to do. And it's all friendly. I mean, everybody knows everybody else.
Bidding war, yeah, I'm sure it gets pretty crazy out there. Just let them out of the asylum, sort of a thing.
It does, yeah. It's not violent, but yeah. And again, it depends on their appetite.
Right.
Okay. That's really it.
Now, are they able to sell maybe just a portion of their policy as well, or is it do they have to go all in?
No, they could sell. No, I just did one a month ago, where he had $4 million of coverage, and we sold $3 million of it, and they kept $1 million. So there are instances where, again, if all the stars line up, we can sell a portion of it, and the original owner or the life insured can keep a portion of it. We also can do something that's kind of novel. It's called a retained death benefit. And with a retained death benefit, somebody could have a policy, and let's say it's $1 million policy, and for some reason the buyers don't want to give them any money for the policy, but the buyers will step in and say, we will assume the premiums from here until a death occurs, and we will give your estate or your beneficiaries you'll retain some of the death benefit. So if it's $1 million policy, and let's say that the insured cannot afford the premiums from this point forward, we can get people to come in and assume or take over the premiums, and then when a death occurs, the beneficiaries will get a portion of the proceeds. An example, if it's $1 million policy, they might be able to get $100,000 upon the passing of the insured, or some number like that. Okay, so there's that's another little wrinkle, because the buyer doesn't want to commit to upfront money, buying the policy, and then assuming the premiums. The buyer just wants to assume the premiums and will let the beneficiary participate in the proceeds when the insured passes on.
Gotcha. Now, what if somebody decides as they go about doing this, maybe they're in the process, or perhaps some of it has actually happened, they change their mind?
Depends on the state, Daniel. They usually have. There's it's kind of like when people used to buy cars, that they would have a 10-day or something like that, a 7-day right to unwind the transaction. in these situations, each state is different, but there's usually it's called a rescission period, and there's usually depending on the state, there's a 2 to 4 week rescission period where the whole transaction goes through, things are changed and everything else, but the seller has the right to come back and say, you know what, I never cashed the check, or even if they cash the check, I'd like my money back. I'd like my policy back. I'll give you the money that you paid, and I've decided that I want to keep that policy. Mm-hmm. But that's available. That option is available. But in doing this for 15 odd years, I've never seen that happen.
Gotcha. Now, go ahead.
No, I was going to say, but that helps, with this elder abuse problem and everything else, so that, there's kind of a can't remember what you call it, but there's kind of a cooling off period, so that if the beneficiaries come back and say, you took my mother's policy, we shouldn't have sold it and all that, and we go, no problem, here's your money back, and we'll try to make the situation whole again, so that you've got your policy, and no harm, no foul. Gotcha.
Now, for our listeners out there, how can they get in touch with perhaps you, or how to go about this process?
The easiest way is my toll-free number, which is 888-322-7678, or my email address is Alan, A-L-L-A-N, Silverman, all one word, at hotmail.com. So it's either 888-322-7678 or Alan Silverman at hotmail.com.
Now,
so that's
and understanding life insurance regulations, are you able to work with people in any state?
I'm licensed in most states, and so it's not a big problem. And most of my, I'll call them buyers, they're really called providers, but most of them are licensed in every state. If they're not, they can find a substitute buyer, and we can work it out. A substitute provider that is licensed in that state. But for all intents and purposes, we can do it anywhere in the United States.
Well, very good. Well, Alan, this has been very enlightening. I'm certainly for our listeners out there as well to be able to see about making some decisions, especially when it comes to their financial future. And if you can, for our listeners again, give out that contact information again.
My toll-free number is 888-322-7678, or they can send me an email, Alan, A-L-L-A-N, Silverman, all one word, at hotmail.com.
Very good. Alan, thank you so much for joining us here on the Beyond 50 radio program.
I appreciate your time, Daniel. Thank you.
You bet. We want to thank you, the listeners out there, for tuning in. Discover more by visiting us at beyond50radio.com. That is the number 50. Sign up for our free weekly e-newsletter as well. You can also follow us on Twitter at Beyond50Radio as well as Facebook. I'm Daniel Davis. Thank you for tuning in. This is the Beyond 50 radio program, and remember, live your day past halfway.